So why is India of interest to anybody here? Some of us are of Indian origin, but really the interest driven towards India today is because of India's rising GDP. Right? India this year crossed $2.8 trillion in GDP, which means it's larger in absolute terms than the economy of France. Okay. Later this year or early next year, India's GDP will cross that of the UK, and that might get accelerated with this advent of Brexit if that causes trauma to the UK economy. So the only economies larger than India will be the United States, China, Japan, Germany, and that's it. Right? All of those markets have been explored for decades and more. So the next big opportunity in many ways for US and European companies, if they are not already there in a significant way, is India. And I don't expect India's ranking in global GDP to rise any further for a long time, because crossing Germany or other countries will take much longer. However, the economy is growing faster than any other major economy in the world, 7 to 8% growth, and we'll see what happens in the parliamentary elections next year. If this government comes back and the crazies in this government don't take hold of it, the potential for growth in India is easily 10 to 12%. Okay? Whether that happens or not will depend on many factors. But what I want to do first is address a couple of key subjects. So my day job is helping American companies succeed in India. I run a company called Amritt. I also wrote a book on doing business in India, and I write for the Harvard Business Review about doing business in India. But what I thought was we'll first focus on the two people who have joined me on stage, because they have very specialized and deep knowledge in two subjects that really go across anybody wanting to do US-India business. So on the right is Bagla with PricewaterhouseCoopers. It's still called PricewaterhouseCoopers, right? Yeah, PwC. And he is an expert on international taxation, a subject that can be pretty significant if you're doing business across multiple countries. And then to my immediate right is Richard Wortman. Richard runs the Los Angeles office of, I can never say the whole name, GDLSK?
Just say that.
Yeah, okay. And he is probably the foremost expert in Southern California on the subject of international tariffs, customs, duties, and so on. If you've been following the news over the last several months or year of the people who are leading our country in Washington, the issue of taxes and tariffs is far more significant today than it used to be. So what I'm going to do is first talk about those two issues, and then some of the questions that came up from the audience about other subjects, we'll address them. Either I'll ask one of our panelists or I'll try and address them myself. So let me start with you, Bala. Bala may have to leave early. Sorry that we are running an hour behind schedule. So tell me, if I am doing business in both US and India, what taxes, why should I worry about taxes, and why could that make a difference to my bottom line or to my investors, or what traps might lie if I don't do it right?
Really good question, Gunjan. So just in terms of why it matters, as you said, it's a bottom line issue. The last thing anybody wants to do is pay tax on the same amount of income, both in the US and in India, right? Now, the tax rules work to address that and try to ensure that duplication is minimized to the extent possible, but it doesn't always work that way, especially given the really contentious situation that the Indian taxman often finds himself or herself in, where they demand pretty unreasonable sums of money from US businesses. And so there is really a need to be watchful about that.
So you think the problem is primarily in India?
Absolutely. We have a number of clients who face significant tax challenges from an India perspective. And a lot of it has to do with the fact that India would say, We don't care about the type of operation you've set up here. We think a cost plus 5% markup for setting up an R&D center or a call center or software development is not really sufficient from an India perspective. So every other major country in the world would say, for the type of work that's done in India, cost plus 5 to 10% markup is sufficient on which you would pay taxes locally. India starts the negotiation at cost plus 20%. So there's a huge delta between the cost of doing business in India from a tax perspective compared to doing business in many other comparable jurisdictions.
And does this apply primarily to companies who have India as a cost center versus companies that are making revenue in India?
It primarily applies to companies that use India as a cost center. So the gentleman that is going to be setting up an R&D center, when you get that scaled up, when you hire employees, and when you start serving the US multinational, usually there's a transfer pricing or intra-company arrangement that's put in place that would say, if the cost of the Indian infrastructure is $100, the profit that's expected to be earned on that from a overall economic perspective generally is about 5 to 10%. Meaning that entity simply acts as a captive, it's not making sales locally, all the IP that's developed belongs to the US parent company. But India would say, no, that's not sufficient, you're going to have to pay more.
Okay. And is there, if I turn to PwC for guidance, do you have creative ways in which we can position this? You don't have to give the answer, you don't have to give away the secret sauce, but are there ways to deal with this? Do I go to Ireland and set up a company there, or the Isle of Man, or Mauritius, or Malta, or what?
There are a number of things that can be done. Having said that, India, China, Brazil are countries where it's very difficult to do the type of planning that you can do with some of these other countries you mentioned, right? Just because the tax systems are inflexible. Having said that, I mean, there are tried and tested ways. We are seeing a lot of interest, for example, for companies going to the taxing authorities in both countries and saying, let's conclude an agreement. It's called an advanced pricing agreement. Let's conclude an agreement that will clearly delineate what amount of income is expected to be earned, what amount of taxes will be paid, and that can help provide some certainty, upfront certainty in terms of the taxation.
Okay, awesome. Does anybody have any questions for Bala on what you just heard?
And one thing I'll just mention as people start thinking about the types of things they'll want to focus on from a tax perspective. You have to think about the cross-border transactions as it relates to India from a life cycle perspective. What do I mean by that? I mean that you have to think about what makes sense when you're setting up an operation. So if you want to enter into a joint venture, if you want to set up a wholly owned captive entity, India still has some very lucrative tax holidays. There is a SEZ scheme that is still available for ventures that are set up prior to March of 2020. So it is almost the last opportunity for companies to be able to take advantage of. And the key benefit is you don't get to pay local income taxes except for what's called a minimum alternative tax for the first 5 years. Then you pay local tax in India at 50% of the normal rate of tax that you would otherwise pay, which, as you folks know, is about 35% for corporate entities. And then you can extend it by another 5 years subject to meeting certain requirements. That scheme is scheduled to be phased out after 2020. And most companies that are looking to set up operations in India probably should look at that to see whether that SEZ scheme is something that could be of benefit to them. So that relates to the formational issue. Once you get the entity up and running from an operations perspective, that's where this transfer pricing issue comes in. Depending on what the Indian entity does, you're going to have to figure out how much income or profits to leave in India and how much tax you're going to owe on it. If you have a tax holiday, obviously that takes some of the pressure off of determining what the appropriate compensation should be for the Indian company. And then the third issue is really when you want to take any surplus cash out of India, India also has a very onerous dividend distribution tax, which is another 20%. So anytime you want to repatriate earnings from India, you have to deal with that. There are certain techniques available to mitigate that, but unfortunately, India has been shutting down a lot of the loopholes, if you will, in terms of cash repatriation. So from a life cycle perspective, think about the formation issues, think about the operational issues, and then finally think about the end game in terms of either selling your Indian operation, which will likely be subject to capital gains taxes, or extracting cash from India from a repat perspective. So those are some of the things that you may want to give some thought to.
Okay, so let me just add a couple of points. Bala used the term SEZ or SEZ that some of you may have heard of, but let me just clarify. It is what is called a special economic zone. And in the old days in India, a special economic zone meant you had to go to a particular location, the Santa Cruz Export Promotion Zone in Mumbai, and that was a designated area where you could set up these kinds of facilities. Well, today, it's not like that. You can pretty much, with minimal paperwork by Indian standards, designate your office or your building as a special economic zone, and then you can perform those types of transactions. You're limited on some things you can and cannot do, as you might expect, but it's pretty straightforward. So I was in Bangalore just recently, and the Texas Instruments building is designated as a special economic zone. We went to another facility, in the midst of an industrial estate. Most of it is not, but some buildings are designated as SEZ. So it's pretty straightforward now, relatively speaking, to set that up. The other thing I wanted to clarify, and correct me if I'm wrong, brother, you've talked mostly about corporate income taxes, right? There is no discussion here in today's forum about personal income taxes. That's another subject maybe for another, for another panel. You also have not talked about or needed to talk about like the goods and services tax in India. That's also a whole big discussion we can have. It's one of the big positive improvements in India that has been implemented by the Modi government. Does anybody here, is anybody curious about or care about the GST? Okay, so maybe very briefly in 1 minute or so, you can explain what that is.
So actually two topics. One is GST, and then I'll briefly touch upon M&A. I think one of the audience members had an interest in understanding about deals and what's going on in that space. So first with GST, it's been a painful process. Again, I'm not an indirect tax expert, so I will try to explain it to the best of my ability. From what I understand, once the GST process is fully implemented and is operational, it is, at least on paper, supposed to make things extremely easy and streamlined in terms of being able to trace the flow of products through the entire supply chain with the least amount of tax outflow that's possible. The way the system has been set up, it puts the burden at each participant in the chain to go to the previous or the party on the other side, the counterparty, and make sure that the appropriate documentation is received so that the party that's purchasing a product that is subject to GST is entitled to a GST credit. So let me give you an example. If business number one is selling product to business number two, and that product is subject to whatever the applicable rate of GST is. Used to be the case prior to GST that business number one would say, come back in 6 months, I'll give you a receipt, or let's make sure that this transaction is not recorded, and I'm happy to give you a rebate or whatever other below the table type of an accommodation such that nobody is wiser about this transaction. The government doesn't have to know anything about the fact that business one ended up selling this product to business number two. What GST forces the two participants to do in this case is business number two cannot get credit for the GST that it has paid unless it obtains a record or receipt from business number one showing proof that X amount of GST has been withheld. If that piece of paper or if that transaction is not recorded, then business number two is not able to claim any credit for the GST, and then as it transacts and sells the product further down the chain, not being able to take a credit for the input GST is going to result in an out-of-pocket cost. So on paper, the system has been very well designed, and it's supposed to streamline the process such that the inputs and outputs from a GST perspective are tracked at each stage of the supply chain, and the participants end up getting credit for their fair share of the GST that they have suffered, depending on whether they are the purchaser or the seller in the transaction. And if it works properly, just like with the sales tax system in the US, it is supposed to be a net zero outflow, because whatever you're collecting is going to be remitted and passed on to the government or passed on to the next participant in the cycle, such that it's not going to result in an out-of-pocket tax cost. There has been teething trouble, there has been issues in terms of getting it operational, but once it's done, to your point, Gunjan, it is supposed to simplify a lot of things.
Yeah, great, thank you, thanks for that perspective. So let me just add a couple of minor points, and again, correct me if I'm wrong. So the term on paper, as used by Bagla, was metaphoric. Okay? The entire GST system has been implemented in electronic form. Right? So it has been, imagine, for those of you who are in IT, it's a very significant big data problem. Right? When you have millions of businesses who are buying from millions of other businesses who are buying from yet other businesses, and the government is tracking all of that. Okay? So it's, they went to a fully electronic system pretty much from day one. And the burden of doing this is largely falling on the larger companies. So at the end, if there is some chaiwala who's delivering chai to your, to your location, he or she doesn't really have to perform the paperwork, because the buyer has to take the onus of filing the GST for the really small businesses. Okay, so and people may have issues with that and so on. But the main advantage, okay, which we shouldn't lose, is in India there are 29 states and 7 union territories. And the way the system was set up was moving inventory from one state to another sometimes meant paying costs that were irrecoverable. That you just, because you moved your inventory, you would pay a cost, and if you moved it back, you would pay another cost. All of that is now gone. So India is one unified market. And that's supposed to result in a 1 to 3% increase in the GDP over time, once these kinks are worked out. So it's actually a very positive thing, and there are many, many issues with it, but overall the system is working, and I think we probably said more about this subject than the audience wants us to get into right now, but it's a good thing, and the GDP growth will increase, and it's not dissimilar to systems in Canada and Europe and so on. It's a value-added tax, basically. Okay. Are there any other tax aspects, capital gains or anything else that have huge impacts on multinational businesses?
Or small businesses, it doesn't matter, right? So
multinational meaning in two countries.
Absolutely. So the size of the business doesn't matter. So I'll mention two things. One is M&A. Based on statistics that have come out for the first half of the Indian fiscal year, which began in April, there's already been a significant increase both in the number of M&A transactions, and by M&A, I'm talking about inbound deals into India. So non-Indian companies making acquisitions or making investments into India. In the previous fiscal year, for the first half, and I'm trying to do this from memory, the number of transactions that happened in the first 6 months was about 8,000 transactions, 8,000 deals. That number has gone up to 8,700 for the same time period in the current fiscal. The dollar amount of investments, which comprise of both strategic investments and private equity investments, have gone up to $52 billion in the first 6 months of this current fiscal year. Now, keep in mind that a good chunk of that, about 20 billion, represents the Flipkart transaction that Walmart undertook, right? So that may be an outlier that may skew the numbers a little bit. But having said that, what my colleagues in PwC India are telling me is that they are seeing a tremendous interest in cross-border deal flow. The one new area that has garnered a lot of attention from US private equity and other investors is M&A as it relates to distressed assets, meaning that what Prime Minister Modi has been attempting to do is to clean up a lot of the non-performing assets of various banking institutions in India. And that is forcing the banks to take action to figure out either to write off those investments or if there is a willing private equity buyer or somebody coming in that wants to purchase a portfolio of these assets and see what they can do to recover against it, there is a significant amount of US private equity investments that are flowing into that space, seeking to work with the banks and financial institutions to be able to harvest that. That is on top of the ongoing investments into technology, life sciences, manufacturing, and other areas of focus. And in fact, the number of startups, and this is again a stat that PwC India shared with me, the number of startups in India rose to 5,000 in the first half of fiscal 18, if I remember my stats correctly. And India is now the third largest incubator of startups behind the US and Israel. So those are some things that I think would be of interest as we continue to monitor what's going on. Last point, capital gains tax, favorable treaties that India had with Mauritius and Singapore to eliminate capital gains on the sale of shares of an Indian company, those provisions have been eliminated. Meaning any new investments after April of 2017 will no longer qualify, even if made through a Mauritius holding company or through a Singapore holding company, for any sort of an exemption from Indian capital gains tax. Any investments that were made prior to April 1 of 2017 will get grandfathered. So if and when an investor, let's say, that set up a company 20 years ago, decides to monetize that and realize gains, so long as it's held through Mauritius or Singapore, will still get a capital gains exemption. But India is in the process of shutting down a number of the loopholes that used to previously exist with certain income tax treaties. So hopefully that answered your question.
Absolutely. Thanks very much. All right. So while we are on the subject of governments and how governments deal with one another, so one issue, as we saw, was relating to the taxation of income or capital gains, which is really another form of income when you sell a long-term asset. The other way in which governments make money, and the way in which the United States made money for the first 150 years of its existence, was through customs duty. Right? So when this country was founded in 1776, there was no income tax. Right? Until, in fact, 1918, 1919?
1930.
1930, yeah.
But it's
so,
into the Depression.
Yeah. So prior to that, the only time there was an income tax was during times of war and so on. But other than that, there was no income tax, and the primary revenue of the United States, as it started, and correct me if I'm off base, was really through the collection of duties on incoming goods. And again, those of us from India should remember that one of those incoming goods used to be tea from India. Okay, and rumor has it that the tea that ended up in Boston Harbor for the Boston Tea Party might have come from India, although there's some controversy on that. Okay, so customs duties have been around for a long time, and over a period of time, governments all over the world have said, well, how do we describe things? Okay, if I buy a wheel or a widget or a blanket or a pillow, and you know where I'm going with this now, Richard, how much duty should I pay? And governments have created this system called the Harmonized Systems Code, the HSC. Is that correct?
Harmonized tariff.
Harmonized tariff, HTS, whatever, yeah. And so the idea is that there's a common language worldwide where you can describe product A and everybody in the world recognizes what it is, and so you look up the tariff for that product and bang, you should know what the tax is. Well, doesn't always work that way. And Richard has given some very interesting stories about how items can be classified or reclassified to the advantage of the importer or exporter. And perhaps you want to give us a little bit of an overview of your world?
Good afternoon. Tariffs are generally based, the harmonized tariff system is that which we've agreed with most of our trading partners in the world to use the same tariff. So in theory, we should be describing merchandise in similar fashions. without getting too far into the weeds, the description goes to 10 digits in the United States. The worldwide tariff only goes to 6 digits. So the same product may be, although described in the tariff one way, described the same way in all countries, is actually classified in different countries different ways. Moreover, each country determines its own rate. So when a client comes to me, the first thing that we do when we evaluate their merchandise and we talk to learn about their business is the first thing we look at is how do you classify your merchandise? By law, in the United States, you must use reasonable care in doing so. What we have found in recent times because of the most recent tariff pronouncements by our president, and I will digress to only say that whatever I make is not a political statement, but we have been looking at classification much more in the past few years. Certain industries, traditionally, we looked at classification, and those tend to be the ones with higher duty rates. The apparel industry, the footwear, and so forth, because the average duty rate was between 20 and 30%. But if you look at hard goods, the average duty rate was 2 or 3%. So 5 years ago, if I asked a company, maybe we should be looking at classification, the answer was, nope, customs hasn't bothered us in 20 years, leave it alone. Today, we now have these punitive tariffs imposed by the president under various statutes that give him either direct authority, that was Section 232, which are for aluminum and steel, or Section 301, which pretty much covers all merchandise. That requires other governmental agencies, but they're also, because they're part of the executive branch, the president conveniently has the power to instruct that agency to impose those tariffs.
Is that only on national defense concerns?
No. The 232, which are for aluminum and steel, are based on national security. Everything else is totally based on what's good or not good for the benefit of the country. And so that decision is made by the executive branch, and these punitive tariffs have been imposed. So there were 3 groups of them. The first group was essentially heavy machinery. Then there was a small group, a second group. So the first was about 20 billion, the next was about 5 to 10 billion, and now there is the last group, which went into effect recently, raising the duty rate an additional 10% in excess of whatever the duty rate of the product was at time of importation. Additionally, the president has committed that if no deal is made with China by the first of the year, that 10% would go to 25%. And that could be done by executive order. So all of a sudden we have a lot of companies trying to either get out of this regime, this punitive tariff regime, by reclassifying merchandise, because sometimes merchandise is in or out, it's all tariff driven. But sometimes depending upon which tariff you're in, the 232s, the aluminum and steel, you can apply for exemptions. To date, between 40 and 50,000 exemptions have been requested, which have overwhelmed the government. They expected to get 500. We're at 40,000. Been about 8,000 denials. There have been 4 approvals. As to Section 301, which is for all other merchandise other than the steel and aluminum, the last number we saw is that for Section 1, there have been several thousand requests to be excluded. There have been a number of exclusions. There have been 0 approvals. The second round, the second tranche, actually December 18th is the last filing date, so we won't hear about it yet. And just to make it fun, the last batch, which is the largest, the third tranche, which was $50 billion worth of goods, I'm sorry, $200 billion worth of goods, the administration decided there shall be no process to exclude. So if you're in based on classification, you're in for either 10% or next year, presumably 25%. Part of the problem that we have found in this whole tariff scheme is that the administration really is focused on what I would say, in my opinion, is not necessarily the end game. They're looking at specific things for different reasons. So in the aluminum and steel, they looked at inputs. They want to encourage manufacturing in the United States. At least that's the purported reason for these tariffs. So if you bring in, by way of example, steel wire, and I digress to say that a lot of steel and aluminum are already subject to anti-dumping and countervailing duties, which are other types of punitive tariffs, but have a long process to be in that case. But if you bring in certain steel, you are hit with a 25% additional duty. However, so by way of example, I have a client who manufactures, they take steel wire, and they have 2 plants, one in Michigan, one in Pennsylvania. Each plant brings in the steel wire, stainless steel wire. The stainless steel wire is heat treated, it's bent, and it's put into concrete to reinforce concrete. It's not rebar, but it's a different type of process used to manufacture, to make tunnels and other shapes that are not your basic rectangle set on the ground. And the way the tariffs were drafted, if they brought in the steel and continued to manufacture in Pennsylvania and Michigan, they would have to pay a 5% duty on the steel coming in, plus 25% additional punitive tariffs. The interesting thing is, a couple of years ago, we set up a factory for them. We helped them set up a factory in China, not to replace the factories in the United States, but as a backstop, because they were so busy that they just did not have any more production capacity here without building a full plant. So they opened one in China as a backstop, and now they have that facility. That facility's up and going. Today, if they bring the goods in from China as a completed article, it comes in duty-free. But if they manufacture it in the United States, out of the imported thing, you have to pay 30% duty on the input. I mean, so the reasoning in this has been quite interesting and problematic. We have spent a lot of time recently helping our clients classify merchandise, especially for people in hard goods area where they have not wanted us to. The interesting thing is that we have found the error rate exceeded 65%. So we have, in fact, had clients who we could, at least for the moment, get out of these punitive tariffs by reclassifying their merchandise. However, what we don't allow our clients to do is just merely reclassify it, because the government has also put major assets at reviewing transactions where importers are changing classification to avoid. In fact, the Department of Homeland Security has allocated 15% of its investigative workforce to customs so that an importer who does change their classification can expect a visit by a customs auditor, a special agent from the Department of Homeland Security, and an import specialist from customs.
Do they have time to do that? I thought they were chasing the caravan.
You know, they can make time to do anything they want. Currently, let me say that for most of our clients, and frankly, it doesn't matter what the industry is. It doesn't matter if we're talking about furniture or apparel. We have been looking at several different things. The first thing is, can we move the production? I will tell you that I have clients who may have historically done work in India, moved it and centralized it to China a decade or 2 decades ago, especially in the soft goods area where there were quotas and other non-tariff barriers, for a whole host of reasons. China was a little more business friendly. It had a better infrastructure, and quality control was more manageable in China. I have clients who 20 years ago moved out of India, are now back looking at India. And again, the question becomes, when you make that kind of move, are you really moving a product so that you are actually manufacturing there, and that its country of origin would be India or some other place in the world called not China. We have also been looking at how to slice and dice transactions. What we have found is that we can probably, through many different means, and I'm not going to go into the weeds here, we can probably salvage 7, 8, 9%, such that an importer who's bringing in a product with a 10% additional tariff, we can probably help them manage the 10%. I can tell you that we cannot manage the 25%. It's just not possible, and it's a major cause will trigger the migration of manufacturer over the next year.
Okay, great. Thanks for that overview. So the reason why this is important to US-India business, as you heard Richard towards the latter part of his comments mention, is that as people are looking at alternatives to China, okay, at least in the work that we are seeing at Amritt, I have not found one example of a company that is bringing manufacturing back to the United States.
That's correct.
Regardless of what our brilliant Orange County export Dr. Peter Navarro might think or say, okay, it just isn't happening. The history of the tariff situation goes back a whole century, and there's never been a tariff war that has led to a victory for anybody. It's lose-lose pretty much all of the time. But again, enough of politics. The reality is, for business people, as most of you are in this room, you have to react because the tariff is a significant cost. And for some of you, it might make sense to look at relocating part of your supply chain in a country such as India. There are many other changes that have happened in India in the last 10 or 12 years. Number one, the infrastructure is getting better. Number two, because of the GST and other things, the flow of goods is getting to be more smooth. Number three, in many states in India now electricity is indeed reliable, so you can manufacture much more reliably. Trade unions and labor problems are a thing of the past for much of India. Not all, certainly, okay? And the emphasis on high quality manufacturing has become fairly significant to the point where today, Ford Motor Company is planning to ship cars made in India to the United States. They've already been shipping from their factory in India to South America and to some extent to Europe. But the Ford Escape made in India will start arriving in the US very soon. Okay? Mahindra & Mahindra, which is an Indian company, is the world's largest maker of tractors. And you don't see them much in California, but if you travel through the American South, Texas, Alabama, Mississippi, you will see Mahindra billboards all over the place. It's made in India tractors being used by small farmers. They don't compete directly with John Deere. John Deere definitely controls the big tractor market. but they are producing world-class quality products for the small tractor market. And there are many, many other examples where this was already happening before this tariff situation. We expect that because of the tariff situation, there will be an acceleration through 2019 and 20. And some of these things are irreversible. You can't say, oh, if the tariffs go away, people will immediately reverse, because it takes months, sometimes years, to find new partners and set those relationships up. So while it's a considerable disruption of the global supply chain, chances are that as things move, many companies in India and many US companies who do business with them will stand to gain in many ways. Okay? The other aspect of that, let me just make this point and then absolutely, has to do with intellectual property. India was a founding member of the World Trade Organization, and the Indian government has almost never been guilty of violating intellectual property. Some Indian companies in entertainment, maybe in software, used to do that. Entertainment is still a problem. But other than that, Indian companies and the Indian government is generally compliant with the expectations of the Western world. Okay? Whereas China has a long track record of violating the intellectual property of companies like Cisco and Disney and Boeing and you name it, General Motors, you name it. Okay? So these things have been festering for a long time, but now there will be an acceleration in certain sectors. So will China lose in the long run? I don't think so. I think China is a huge power and it will continue to be so. But there will certainly be a benefit to many people who want to grow on this US-India business link. Okay, Bala, you wanted to add something?
I just wanted to echo something that both Richard and you said. We are hearing through our network firm in PwC Taiwan, PwC China, a number of Chinese and Taiwanese companies are very interested in looking for manufacturing facilities in India or purchasing operations for the precise reason that Richard articulated. So there is, again, to the extent there are people here or partners with businesses in India that want to take advantage of that, I think there is a groundswell of interest in terms of making sure that Chinese companies have alternative source of supply and they feel that India has something to offer in that regard.
And one other thing I wanted to add was that it's not that US companies are at the bleeding edge in this. Okay? Companies from Korea and Taiwan and Japan and France and Germany and the United Kingdom have been investing in Indian manufacturing for a long, long time. Okay? So you look at ABB, which is a Swedish-Swiss company. They have huge operations all over India. You look at Siemens, okay? A German company. They have 20 factories in India. Okay? General Electric, I think, has 2, correct me if I'm wrong. Right? One in Pune, and now they are trying to build that locomotive factory in Bihar, which is now being sold to Alstom again. So the Europeans have a long track record of doing this. The Koreans have probably mastered manufacturing in India over the last 10 or 15 years. They were nowhere a while ago. And today Hyundai makes many cars in India that they don't even make in Korea anymore. They make them in India and they sell them worldwide. Okay? So this is not a new problem for American companies to solve. Okay? It's one that has been solved by many, many other countries dealing with India. The new opportunity really is for American companies to follow what others have already done. Okay. Any questions on this? Yeah, David.
One of the horror stories about doing business in India involves Vodafone and the tax and the retroactive tax, the threat of retroactive taxation. How active is this more hypothetical, imaginary, or is it shaping business calculations towards India?
People are going to accuse that I planted this question for you, but it's a great question, and I can use a recent example to basically refute the contention that India is looking to gouge people from a tax perspective with respect to certain types of transactions, like the one you mentioned. So, just by way of background, for the people that may not be familiar with this Vodafone case the gentleman brought up, Vodafone involved a significant multi-billion-dollar transaction where both the seller and the buyer of the Vodafone India operations were non-resident companies. India said, notwithstanding the fact that the transaction was entirely done outside of India and based on the tax rules that existed at that time, should not be subject to tax in India, India articulated a very novel approach to say, no, the underlying subject matter of the transaction were the operations of Vodafone India, and that is the only asset that was really being transacted here. So notwithstanding the fact that the buyer and the seller were foreign, we're going to attempt to tax it. Extremely controversial, went all the way to the Supreme Court in India. And the Supreme Court finally said, no, this transaction should not be subject to tax in India. So the Indian government then retroactively changed the tax rule to say, henceforth, any similar transactions will be subject to tax. Fast forward to 2018 with the Flipkart Walmart transaction. Another $20 billion transaction. Interestingly, what the Modi government did was to go to both the buyer and the seller and say, we want to avoid a repeat of the Vodafone transaction. So we're going to appoint a special body of tax people because on the sell side, on the Flipkart side, there were a number of private equity firms involved. So each of whom had a presence in different parts of India. So there were a lot of different Indian jurisdictions that had an interest in the transaction. The Modi government said, let's not allow people to mess this up. We're going to consolidate all of the sellers' interests, if you will, and look at the buy side as well. Appoint a special body of about 10 people that the buyer and the seller can approach and work through all of the tax issues up front prior to signing the deal. So it was the exact opposite of Vodafone, where the government said, let's make sure that both parties agree up front as to what the liability for tax is and who's going to suffer withholding taxes, etc. And based on that, the parties went ahead and did the transaction. So why am I saying that? The reason is India is not perfect by any means from a tax perspective. There are still lots of litigation going on with respect to transfer pricing matters and other issues. But the government was also pragmatic enough to be able to recognize that a large transaction like this has the potential, if not handled properly, to basically sully India's image again from a global perspective and give pause to investors, so they worked upfront with the parties to be able to get through that issue.
Okay, thanks for that, Peter.
Just to follow up, have you found any companies in the past 2 or 3 years that have approached you and said, I'm interested in doing business in India, but this Vodafone experience is weighing in on my calculation, and am I going to be subject to retroactive taxation and so on? I'm just wondering, is this just a hypothetical factor, or has it weighed on business calculations?
If it does, it probably is not a huge factor. And at the end of the day, people, as you may know, and the folks in the audience know, go to India for a variety of reasons. Tax is a factor, perhaps, and comes in at the back end. But so long as the other factors that cause India to be attractive in the first place are present, labor, infrastructure, knowledge base, time zone differences that can be arbitrage, so on and so forth, those are the things that people focus on. I can't recall a single instance where a client said, it's a great investment, but we're concerned about exit taxes or Vodafone type taxes. It is certainly something that they take into account as part of the investment thesis, but it's not by any means an overriding factor.
Yeah, and what I would add is that I think after the first couple of years of the Modi government, the Vodafone issue pretty much evaporated because they found this new government is very consistent about what they are doing. The finance policy and all of that has, been much more reasonable. So going forward, I think that has become the standard. Will there be some companies that are unhappy about investing in India? Probably. Will Walmart in particular be unhappy about investing in Flipkart? I think that's a whole different question when you pay $16 billion, $18 billion, in a country like India. as Walmart has never been successful with that kind of investment anywhere else, will they really make money in India when they're fighting Amazon there? I don't know. But I doubt that the Indian government will be the reason for their troubles. They've got Jeff Bezos to worry about, which is far more of a serious issue, I think, for them in India. There were a couple of questions that we did not address, and we are running out of time, so let me give you a short answer. Is it possible to do work on a reliable time schedule in India? Oh, it is, absolutely. Okay. Are most transactions in India going to be on a reliable time schedule? No. Okay. But it is really for the American company and its advisors to find the right partners and right relationships where you can perform things on a reliable manner. I promise you that Cognizant and Infosys and TCS and many of the Tata companies in other industries, many of the Birla companies in other industries are absolutely performing to schedule. Okay. They are completely capable today. And there are hundreds of smaller companies who have arisen, created by entrepreneurs in the 1990s, 2000s and later, who run to the same kinds of standards as Western companies. Not all of them. Okay. Majority of them may still have that attitude that a week or two, month or two delay doesn't matter. My brother-in-law's, daughter's cousin had a wedding and now you're, 3 weeks late in meeting a commitment. Yes, that happens. Okay. But also on the flip side, I've seen the reverse happen as well, where an Indian vendor or Indian customer will accommodate for changes in their American business partner's situation. They don't go back and say, oh, the contract says this, and therefore I shall do only this. Okay. The amount of flexibility that, when you have a strong relationship, an Indian partner will not resort to the contract and say, now you got to pay me 13% more, or you got to pay this penalty, or here I'm going to bill for this or that. If you have a strong relationship, those things generally do not, in many cases, do not come into play. So there's a good side, there's a bad side. You've got to choose the partners correctly, and you can't, in India, you can't focus so much on the contract. Contracts are important, but if you don't have a good relationship, the contract is completely meaningless. Because if you have to enforce that contract in Indian court, forget it. Okay? You already lost that battle. Okay? You think of legal expenses as being high in this country? No. The law takes forever to act in India. Okay? So if you don't have a good relationship, you're in trouble. And if you have a good relationship, the contract is secondary. Okay? I know that doesn't answer your complete question, but absolutely it is possible today. There are hundreds of companies doing very professional business in India who are running their balance sheets and income statements in as transparent a manner as you would see, a company that PwC might audit here in the US. That's absolutely happening. It's not a rarity anymore.
I'll go beyond that. I'll say, for example, we have shared services centers that PwC uses for our operations, right? We send them stuff, they work on it, send it back when we're here in the morning. There will be startup trouble. There will be the initial teething issues that need to be worked through. And maybe the size and the scale of what I'm talking about perhaps is different from what you were alluding to, and maybe it's a third-party relationship versus the own captive that we have. But once you kind of work through those issues, I would say, in fact, there is an advantage to be had by having a reliable source of whether it's manufacturing, services, whatever, R&D, that gives a business a competitive advantage compared to others that might not have a similar setup.
Morgan, did you have a question that we didn't answer yet?
No, separately.
Okay, that's fine. Hey, Anurag, did you want to add anything to some of the issues since you lived in India and worked for a large multinational?
Yeah, so I think the issues that you have mentioned, you can create a culture which is as productive as here. So, we created an R&D center from scratch, medical devices. The engineers were coming from different industries, automotive, consumer electronics, or aerospace. Developing medical devices, which is class 3 in 5 years.
So just tell everybody what class 3 means.
Class 3 is most stringent requirement from FDA point of view, where you have to show all the clinical data, etc.
If a class 3 device fails, you die, basically.
So those kinds of devices, we have been able to do that in 5 years from India Center with engineers who didn't have medical device background. So it's possible. You need to create the right culture and the right mechanisms.
Thank you for adding that. Anybody have one last question? David, are you holding something back?
I'm completely satisfied.
Okay, all right. So, I mean, in summary, I'd like to say that India is really the last major underdeveloped opportunity for American companies. I started Amritt 15 years ago because I thought India was under-recognized. Here I am 15 years later, we are doing a lot of good stuff, but India is still under-recognized. Okay? Many other countries outside of the US have recognized the potential in India. And I'm grateful for that because I think I'll have a job for the next 15 years or so as more and more companies start recognizing the potential of India. And those of us of South Asian origin, I think, have a special responsibility to go back to our companies and our communities and help them recognize that India isn't the country of starving beggars and bad news that you see in the New York Times. Read the Wall Street Journal instead, and I think you'll see some of the potential that India has to offer. So please join me in thanking our wonderful panelists here, Bala and Vishnu. And thank you for attending this late in the day. I'm sorry that we got delayed, but I hope you got your money's worth. Thank you. Thanks, everyone.